All right, welcome to this explainer. Today, we're diving into XOS Inc. This is an EV stock that's basically caught in a massive, high-stakes tug of war. On one side, stunning operational triumphs. On the other, some absolutely glaring existential red flags. Let's get right into it. So before we look at the numbers, let's establish exactly what XOS actually does. They develop and manufacture battery electric commercial vehicles. But here's the kicker. They're not trying to sell you a sleek electric sedan for your driveway. No, they are laser-focused on the commercial sector. We're talking medium-duty vehicles, step vans, and specialized fleet platforms. Think about those big delivery trucks dropping off packages in your neighborhood every single day. That's Exos's domain. They're betting the farm on the idea that purpose-built commercial EVs offer a way stronger, more immediate value proposition than passenger cars. And you know what? There's massive structural momentum backing that bet up. The opportunity here is huge because commercial fleets don't buy vehicles based on emotion or how cool they look. They run on cold, hard math. Fleet operators are aggressively pivoting to EVs because the total cost of ownership is shifting heavily in their favor. We're talking substantially lower fuel costs and drastically reduced maintenance bills, mostly because electric drivetrains just have a fraction of the moving parts of a traditional diesel engine. Add in the mounting regulatory pressure like zero-emission mandates in massive markets like California, and broad fleet electrification isn't just a trend, it's inevitable. By offering purpose-built platforms for the daily grind of commercial delivery, XOS has positioned itself right in the path of a tidal wave of capital expenditure. Now here is what gets truly compelling. It all boils down to one number, 38.6%. In the first quarter of 2026, XOS reported a record-breaking GAAP gross margin of 38.6%. Let that sink in for a second. In the brutal, highly capital-intensive world of automotive manufacturing, generating nearly a 40% gross margin on a physical vehicle is, well, it's nothing short of extraordinary. It's the kind of number that literally makes financial analysts stop scrolling and pay attention. Because it proves that when XOS actually builds and delivers a vehicle, the underlying unit economics are phenomenally profitable. When you map out how this builds across the first half of 2026 compared to 2025, the transformation is just staggering. Look at this. Their GAAP gross margin jumped from a pretty meager 11.8% all the way up to 31%. And their non-GAAP gross margin showed a similarly explosive leap, going from just 4.9% up to 29%. So why does this matter so much? Because it fundamentally rewrites the company's survival math. It proves XOS doesn't necessarily need to become some massive behemoth pumping out hundreds of thousands of trucks to make money. If they can just maintain these margins and keep a tight lid on operating expenses, they could theoretically build a highly sustainable cash-generating business on relatively low volume. But, and there's a big but here, just as the margin story gets you fired up, the operational reality hits you like a ton of bricks. Negative 74%. That is the year-over-year revenue collapse XOS suffered in the second quarter of 2026. This is a brutal, whiplash-inducing pivot in the story. I mean, how does a company with such incredible unit economics suddenly watch 3/4 of its revenue just evaporate in a single quarter? Let's unpack the details of this Q2 reality check because, honestly, the metrics are pretty sobering. Revenue came in at a paltry $4.7 million. Why? Because they only delivered 30 vehicles. 30. Just to put that into perspective, in the exact same quarter last year, they delivered 135. That massive collapse in volume absolutely crushed their margins for the quarter, compressing them back down to 12.1%, which in turn led to an operating loss of $7.9 million and an adjusted EBITDA loss of $5.1 million. And maybe the most critical piece of the puzzle here, they ended the quarter with a dangerously thin cash cushion of just $13.2 million. This exposes the fatal flaw right now. XOS has proven they can generate attractive margins, but they've completely failed to show they can produce consistent, reliable revenue and delivery growth. Unsurprisingly, a quarter of this brutal forced management to face the music. Originally, they were targeting roughly $40 to $50 million in revenue for 2026, but after the Q2 collapse, they had to slash that guidance down to a range of $35 to $43 million. This is a highly meaningful negative development, and it forces us to ask a really critical question. Is this Q2 weakness just a temporary timing issue with fleet deliveries? Because if so, that's solvable. That's actually a potentially bullish setup. Or does this signal deep structural demand and production flaws? Because that would be catastrophic. To answer that, we really need to look at their historical financial context. Yes, their cash position ticked up slightly to $13.2 million at the end of Q2, but the full year 2025 balance sheet, it's a glaring warning sign. On $46 million of revenue, they suffered an operating loss of over $33 million. That leaves them with a staggering accumulated deficit of $228.7 million. XOS is carrying a massive history of operating losses. The margin improvements in early 2026 are great, sure, but they are fighting an uphill battle against a deeply entrenched track record of burning through cash. And all that cash burn culminated in basically the most serious phrase you can ever find in an earnings report. XOS's 2025 audited financial statements included a formal going concern warning. The auditors explicitly cited the company's continuous losses and fragile financial condition, stating there is, quote, substantial doubt about their ability to continue operating. For any objective analyst, this is an existential threat. It literally means survival is not guaranteed by the math. No serious investor can afford to just brush this aside. Which brings us to the silent killer of small cap portfolios, extreme dilution risk. Think about it. When an EV manufacturer burns cash but desperately needs to stay alive, what's their move? They issue more stock. In just one single year, from the end of 2024 to the end of 2025, XOS's shares outstanding ballooned from 8 million to 11.4 million. They are effectively using the equity market as their own personal ATM to finance manufacturing, R&D, and those operating losses. So what does that mean for you? It means even if XOS miraculously turns this whole ship around and becomes wildly successful, your slice of the pie as a shareholder will have been dramatically shrunk. But wait, just when the narrative feels overwhelmingly dark, there is a hidden catalyst here that could completely change the game. Enter the Power Hub. See, XOS isn't just building trucks, they're actually building energy storage and charging infrastructure too. In that otherwise disastrous Q2, they managed to produce 29 Power Hubs, which is actually a record high for them. And this is a brilliant move, because it solves the secondary problem of fleet electrification. A fleet operator doesn't just need the electric trucks, they need a way to charge the whole fleet efficiently without completely blowing out their local power grid. If XOS can scale this infrastructure ecosystem right alongside their vehicles, they suddenly expand their total addressable market way beyond just being a niche truck maker. Executing that vision, though, that means surviving a brutally competitive landscape. XOS is operating in a fiercely contested arena. They aren't just fending off other plucky startups. They are going head-to-head with massive legacy truck manufacturers who are aggressively pushing into the EV space. Not to mention larger, established EV companies with billions in funding. It's constant grinding price competition. Strategically, yeah, focusing on purpose-built commercial vehicles is incredibly smart, but manufacturing is ultimately a game of scale. A company producing 30 vehicles a quarter simply doesn't have the purchasing power, the supplier leverage, or the unit economics of a giant pumping out 10,000. They are at a severe structural disadvantage until they can scale up. David versus Goliath is a fantastic story, but in the real world, Goliath usually gets better supply chain pricing. So when you mash all these conflicting dynamics together, the incredible margins, the collapsing revenue, the massive market opportunity, the going concern risk, you get an extreme valuation asymmetry. XOS is currently sitting at a micro-cap valuation of just around $55 million. The market is pricing this strictly as a speculative bet. The bull case is incredibly simple. If they scale back up to $50 million and then maybe $100 million in revenue, all while holding onto those sweet 30% margins, a $55 million valuation is absurdly, almost comically cheap. But the bear case is just as simple. If revenue stays flat and the cash burn continues, it leads to a death spiral. Endless dilution, relentless financing pressure, and an eventual march down to zero. So the crucial point here is knowing exactly what milestones validate a turnaround. If you're leaning bullish, this right here is your exact watch list. Number 1, quarterly deliveries urgently need to return to that 100 to 150 plus range. Number 2, those incredible gross margins have to prove they weren't just a one-off fluke, stabilizing above 25 to 30%. Number 3, the Power Hub business needs to actually scale into a meaningful revenue stream. Number 4, management has to prove they can get near cash flow break-even without endlessly diluting the stock. And finally, number 5, they need to lock in major, undeniable fleet contracts to get some market confidence back. On the flip side, the bear case reality doesn't require any imagination at all. It's quite literally what's happening right now. The threats are immediate. That extreme 74% revenue volatility we saw in Q2, that is a glaring red flag. The company has ongoing, massive cash requirements. The threat is substantial share dilution is hanging over the stock every single day. They're facing brutal competition from well-capitalized giants. Their current manufacturing scale of a couple dozen vehicles a quarter is completely unsustainable. And of course, they have that explicit auditor warning hanging around their neck regarding their ability to even survive. All right, let's consolidate this whole complex analysis into a definitive scorecard for XOS. The industry opportunity. That's a flawless 5 stars. The whole world is electrifying its fleets. The gross margin improvement, a spectacular 4.5 stars. But revenue growth? That drops to a dismal 2 stars, entirely due to that Q2 collapse. Management execution sits at 3 stars, which reflects that weird mix of great margin discipline but total delivery failure. And the risk profile? Off the charts, 5 stars. Put it all together, and XOS earns a 6 out of 10. This is the absolute textbook definition of a speculative turnaround. It's got fascinating tech and an enormous target market, but the financial profile right now is just far too chaotic to call it a high-confidence investment. So what should an investor actually do with all this? If we break it down objectively by risk tolerance, the action plans are pretty clear. For the highly aggressive speculator who is totally comfortable potentially losing their entire principal, a very small position might capture that massive asymmetric upside. For the moderate investor, the play is strictly to wait and watch. You want to demand at least 2 to 3 consecutive quarters of higher deliveries, stable margins, and controlled cash burn before you even think about stepping in. And for the conservative investor who's just looking for a reliable compounder, XOS is a definitive avoid. There are just way too many unproven variables when it comes to scale and basic survival. And that really leaves us with the ultimate question to wrap up this explainer. When you look at all the data, the phenomenal margin potential on one hand and the terrifying operational inconsistency on the other, what are we really looking at here? Is XOS a brilliant, overlooked EV gem that the market has unfairly punished, just waiting to scale up those massive margins? Or is it the ultimate high-risk value trap destined to continually burn cash and dilute its shareholders into oblivion? The mechanics of the market are going to decide soon enough, but the data is all right here for you to weigh. Thanks for joining me on this deep dive, and as always, keep digging into the numbers.